The spreads are closing, but that's actually really good news. Today, I want to focus on interest rates, what's happening with them right now, and how it's impacting the real estate market, and then what's likely to happen to them and how that's likely to impact the real estate market. Now, if you have no clue what spreads could possibly have to do with interest rates, don't worry. We're not talking about butter or cream cheese. Just stick with me and I'll explain, because what we're talking about is a window of opportunity that is closing. Much of the focus when it comes to interest rates is usually on Fed policy. Since you're not new here, you already know that the federal funds rate is not the direct equivalent to what you would be offered if you went and applied for a 30-year fixed mortgage. But Fed policy and what the Fed chooses to do with their balance sheet and where they keep the federal funds rate at definitely impacts the demand for mortgage bonds. If we're talking about interest rates and we're not talking about the Fed, then most likely we're talking to somebody who passed Econ 101 with a grade higher than 60%, at least. In that scenario, you're likely talking about a recession because in times of economic uncertainty, the demand for mortgage bonds has historically improved, bringing interest rates down. If this is a hypothetical conversation with someone who's equally well versed in the way money works, then we're debating the odds of a job loss recession specifically and how that would impact the economy and in turn impact interest rates. Here's what people don't often talk about when they're talking about interest rates: the spread between the yield on the 10-year Treasury and the current 30-year fixed interest rate. I've broken this down in layman's terms on a previous blog months ago, so I'm not going to rehash the whole thing now, but here's the long story short. Normally, there's a 1% to 2% difference between whatever the yield is on the 10-year and where mortgage rates sit. This means if the yield is at 4.2%, like it is today, you would see mortgage rates at 5 or 5.5%. That's the historically normal spread, and based on the technicals, we should have interest rates in the fives. As you probably know, we don't. They're at 6.5%. That's almost a 2.5% spread, which is lame, but it's not the worst that it's been. In 2008, the spread hit almost 3%, 300 basis points, and we also saw something similar to that at the onset of the 2020 COVID-19 panic. A larger spread represents higher borrowing costs for home buyers. A smaller spread would mean lower interest rates without any action necessary from the Fed. The spread has started closing, and it's something that you should be watching very closely because it's another predictor of where interest rates are headed. Why obsess about interest rates? I know. I usually tell you not to try to time the market, that's like trying to catch a falling knife, right? You're going to bleed. But I've also really enjoyed helping my buyers get deals the past couple months. Get price reductions, get seller concessions. It's honestly been glorious from our side. We're over here on the buyer side only. So I'm having some feelings about this window of opportunity closing as interest rates come down. Yes, I love lower rates. Yes, I love refinances. But we all need to be aware of what that means for supply and demand and how it's likely going to impact home prices as buyers come back into the market. I was about to say as buyers flood back into the market, but I decided to tone down the drama. So will she narrow or will she widen? Was I going too far calling the spread a she? I know, words can be very charged these days. Forgive me. It was just a little humor. The spread closing is conducive to lower rates, and we've already seen this trend begin, which has resulted in an increase in mortgage applications. The funny thing is, as mortgage demand picks up, this could create a snowball with the spread because more demand for mortgages increases lender competition, compresses margins, and that causes the spread to narrow, which would cause even lower interest rates. There is also more clarity now on Fed policy, with a September rate cut being estimated. The probability of it happening is at 80%. That decreases volatility because it gives investors a prediction on monetary policy. And that requires less cushion over treasuries, which also narrows the spread. On the other hand, economic volatility, which seems to be our president's preferred method of doing business, will widen that spread right back out. We saw this at the beginning of the year. Spreads started to improve and trend in the right direction, but then economic and policy shockwaves hit the financial markets one after the other and flipped our progress. There's also going to be a new Fed governor in other mortgage-related news. Now, this is not a replacement for Powell. Powell is the Fed chair. His term ends in May of 2026 unless Trump fires him before. This week, Fed Governor Kugler stepped down 6 months ahead of the end of her term, and that gave Trump the opportunity to appoint a new governor, and he chose Stephen Moran. We know they're chummy already, but Senate has to confirm him before he gets to sit on the Fed, and we're not sure if that'll happen before the Fed meeting on September 16th. There was also other news this week that I don't have time to hash out now, but I did recap all of it for you on Property Pursuits, so you should check out the recording. Also, make sure that you grabbed your spot for our free virtual event coming up this Wednesday. It's called Straddling the Paradox, and if that confuses you, go check it out and then grab your spot because it's open to women everywhere.